Hi, this is George. In this video, we are going to see about Bank Nifty ratio spread with some few adjustments. Before getting into the video, please do subscribe to this channel and also join our Telegram channel for instant updates. Also, please do like the video if you genuinely like it. Let's jump into the video. So this is again an interesting strategy where the loss can be minimized so much, or it can be even would be like kind of a no loss strategy. And in this, the capital required is around 1.5 lakhs. In this ratio spread, we are going to have like a spread of 1:3:2. 1 and 2 are the buy legs, and 3, the one in between those is the sell leg. The payoff chart will be looking something like a butterfly or a Batman kind of thing that you can see in the chart when I gave you the simulation of Obstra. In this video, I have given manual backtesting for the last 16 weeks in the Bank Nifty weekly options. Again, as I said before, like it's only very few adjustments are there, so this is very much suitable for working professionals and part-time traders. Disclaimer: this is only for educational purpose. Please do your own research before taking any trade. This is not a recommendation, but just my view. So in this, the entry is like just like our every other videos, like for weekly options, we entered the previous expiry Thursday at 9:30 in the morning, and we exit on the current expiry day at 9:30 a.m. We close the trade at the morning so that we can concentrate more on the expiry trade on the expiry day. So in this, for example, I'll just give you like what is it 1:3:2. So we buy one lot of 500 strikes away ATM call and put, and we sell 3 lots of 1500 strikes away ATM call and put, and we buy 2 lots of 2500 strikes away ATM call and put. So for example, say suppose if Bank Nifty is trading around 35,500, then we buy one lot of 35,000 put option, and we buy one lot of 36,000 call option, and we sell 3 lots of 34,000 put, and we sell 37,000 CE3 lots, and we buy 2 lots of 33,000 put, and we buy 2 lots of 38,000 call. So this is the setup here. Now the adjustment part is like it's a very simple adjustment. Like we see the payoff chart every day in the morning at 9:30 a.m. just and if market is like suitable for us, we do the adjustment. The adjustment is like the only thing that we do is like we kind of shift the buy leg towards the nearer premium. That is in the previous slide I've shown like 1:3:2, that 2, which is like 2,500 points away from ATM. That one, whichever the premium is eroded, whether it is a call side or put side, wherever the market goes, the side where the premium has eroded, that's it, we move like maybe 300 or 400 points or whichever, like maybe like around 5 to 10 rupees extra we pay, and with that we will try to bring the strike closer to that. By doing that, we'll be risk free on the side that we are doing, and also in that side, if market moves so violent, we'll get a very handsome profit. But generally our intention is like not to get more profit, but to reduce the risk. So once we do this on both sides, say suppose like in the 5 days, market one day it will open in the positive side and the next day it will open the negative side, or even if it doesn't move also, like the premium decay will happen, and we might be able to do both sides these adjustments. If we do the adjustments in both the sides, then we will be protected in the both side any violent direction movement. We'll be ending up in loss, that too not a very big loss, only if market remains sideways, that is if it is kind of almost neutral. So this is a kind of a risk-free trade. So we can close if market gets violent on the very next day of our trade. That is like if say suppose we are, because we are protected only like around 2,000 points, we'll protect it. So if suppose market moves more than 2,000 points in 1 or 2 days, then we'll get into trouble, we will lose more. So say suppose if the next 2 days, 2 trading sessions, Friday and Monday, if market moves more than 1,000, 1,500, 2,000 points, and if you feel like okay, let me close it, if suppose market keep going in the same direction, if you might end up in loss, then you can always close this. So this might be like little difficult to understand just by theory. Let me just take you to the option and explain you what I was trying to say here. So this is the chart that I've given for the 16 weeks. So as usual, we'll see the best case scenario that has happened on 28th of July. So 28th of July, so we will have entered on 21st of July. So 9:30 will be entering. So 21st of July market was at 35,990, which is 36,000. So 35,000 we will be buying, 35,500 will be buying one lot, 34,500 we will be selling 3 lot in put side, and 33,500 put we will buy 2 lots. If we do this side the payoff chart will be like this. Similarly for call side we'll do 36,500, let's buy one lot, 37,500 we'll sell 3 lots, 38,500 we'll buy 2 lots. With this our setup is done. You can see this is what I was saying, like kind of butterfly or Batman kind of payoff chart, whatever you want to call, you can name it. So this is how it is. So at 9:30 this is, so buy legs, the legs that will be moving are only the one which is like 2 plus 2 plus 2, that is the 2,500 points away from strike. So this 14 rupees and 7 rupees. We'll see next day. You can see that 14 rupees has went to 6 or 7 rupees. Now we are going to make adjustment. What we are going to do is we are going to close this at 7 rupees and we will find something around 14 rupees and we'll buy for PE side. So PE side somewhere around 14 is this one, almost 15. We are going to buy this 2 lots. As I said, if we do that, now if you go and see the payoff chart, the PE side we are risk free. You can see like we are going to get profit about 14,000 minimum, and the last year is like only 5,000. Initially also the between range was very less only, it was maybe some 5,100 or so, but now after doing this it has increased to maybe 300 rupees, 400 rupees. But this side you are totally protected. This side you can see 30,000 losses there. Initially this side also you would have seen around 30,000 loss, but that has totally changed to profit in the every direction. Now we are going to see what happens in the next day. Now you can see like put has still reduced, but still anyway we are going to be in profit. We need not do any adjustment. Put side, call side is the only thing we have to see. It is in the positive side only, like from 7 it has went to 12. So let's wait. Now it has went to 5 rupees. Maybe we can do adjustment here. So this which we bought at 7 rupees we bought. Now we are going to sell this at 5 rupees and we are going to buy something around maybe 10 rupees, we can say, call side. We are going to pay only extra 5 rupees. We are buying this at almost 10 rupees. You can see like now the payoff chart is going to look like something like this. Initially 30,000 was the max loss. Now that has reduced to only 5,000. And this side you can see like 14,000, as I said before. You can see what we did is like we have just moved 33,500 to 34,400. We moved actually very big direction, 900 points move we have done in the PE side, and call side also 38,500 we closed and we moved 500 points away, and we are now at here 38,500. We can even see on the next day what it is happening, and if anything we can further make adjustment. Okay, CE side you can see like it has went to 4.3 rupees. Maybe you can close this at 5, and again you can see somewhere around 10 rupees, and you can buy that at CE side. Okay, this is almost at 10 rupees. Now if you see that, you can see the chart to be like this. Totally you are protected in the both side, and only in the this side, which was like around 5,200, 500 something. Now it has went to max loss of 6,000. So by this you can see like only this range you are going to end up in loss. That too, you know that this is the maximum loss that you are going to have, which will make you comfortable that you can take this trade. The next day you can see like market actually went in our favor and we have made a profit of 12,666, which I might have given here. Actually I've given only 10,168. The reason was like I think I have not executed this trade. See, I didn't do the second adjustment. Let me just show you what it would have been if I didn't do the second adjustment. We have not executed this trade. If so, then we would have ended on 3,200, which is what I have given in this chart, which means like it was like almost only 2 days left when we made this adjustment, and we had a range of more 1,000 points, and even if it moves more than that 1,000 point, we are going to lose only 5,700. So maybe I would not it is totally up to you. It is personalized. If you want, you can do this adjustment. If you don't want, you cannot. You can leave that also, because you can see like even if market moving, like the next day market went down and again market went up, you made more profit of 2,000 rupees. Here you can see 10,200. Previous case we saw somewhere around 12,000. So it is not going to very much impact unless and until it is a very big move. Like maybe if 1,000 2,000 point, then yes, definitely you will be like here it will be 5,000 something loss, but there you will get more profit, like maybe 15,000 20,000 or more than that. So it's totally up to you whether to carry out that trade or not. So this is one kind of this is the best case scenario that I was saying. We will see one case where we made a loss. So 14th of July we had made a loss. Sorry, 14th of July means we have started the trade at 7th of July, and its expiry was at 14th of July. Market is 34,600, so 3,400 we'll buy one lot, 3,300 we sell 3 lots, 3,200 we buy 1 lot, sorry 2 lot, 3,500 we buy 1 lot, 3,600 we sell 3 lots, 3,700 we buy 2 lots. With this, our payoff chart will be like this again as usual. Now the next day we'll see what is happening. 17 and 9. Okay, so the 17 has become 6 rupees. So maybe we can make this as maybe somewhere around 7 we are selling, and somewhere around 17 we'll buy a PE. Okay, here we get, so we are buying PE leg. C has not moved much, 9 to 8, so we can wait. P side, now it is fully risk free. Now we'll see what happens to C side. It is at, okay, C side also, like now it has went to 5 rupees. Maybe we are closing at 5 rupees now, and somewhere around 10-12 rupees we'll buy for C. Okay, 11 rupees is there, we'll buy C 11 rupees. So once we do that, you can see like this side it is going to be loss is reduced, but again we can see if we want we can further reduce also. Let's see what happens next day. 8.2 maybe, okay, if you want to make it as risk free, then you can further move on to strikes. We'll see what happens if we get again maybe somewhere around 12 rupees or 13 rupees. Okay, we'll buy that. Now if you see
July 14th, 2022.
Now if you see it is almost risk free in the upside also. So in this case actually what has happened is like market went in between and it has expired, so we made a loss of 4,900. This is what I have given here. So this is a case where market is ending in between both the legs, both the profitable sides. So this is one case, and 2 more other cases that I have highlighted also I'll explain. So one is 26th of May. So for 26th of May we would have entered on 19th of May. So 33,500, so 33,000 will buy 1 lot, 32,000 we are selling 3 lots, 31,000 we are buying 2 lots, 34,000 we are buying 1 lot, 35,000 we are selling 3 lots, 36,000 we are buying 2 lots. I think I have not mentioned before, like as I told, like both the side it will be very big loss initially, 29,000, 28,000, and just to reduce that we are doing these things, like we are kind of reverse buying, so moving near to the strike, so that we'll be like kind of after 1 or 2 days only we can be like have peace of mind that we'll, no matter where market goes violently, we will be in profit. So for that mindset only we are doing this. So now if the very next day. So okay, this is the actual best case scenario. You can see like both the buy legs that we did, both has eroded so much, which means market has not moved. You can see like 33 500 or something we saw, and we though 400 points it has moved as because IV was more. Both the strikes which was 2500 points away has reduced so much. So now we'll be like booking somewhere around this at 15 rupees and this at 17 rupees. And put side maybe we are going to buy same somewhere around 35, so we'll see. So around 35 we are buying. If suppose 37 we'll say 2 lots, and call side what we had was 25 something. We'll see somewhere around 25 or 30. 28 is there. So once we do this thing, then we can see like we are like almost protected this side, and this side also only 11,000 loss. So now if we see, though market goes, I'm not going to change again because it's a very lengthy video, so we don't want to make more time in this. You can see like we are making profit. Still the zone was more, and even if it is moving also like 11,000 loss, which is bearable if it is fine for you, or else you could have do the adjustment. You can make this side also risk free, and this side only maximum loss would have been like 6,700 or 7,000 max. So this is one kind of scenario that you might encounter. The final is like 12th of May. So 5th of May we would have entered. So 35,700. So 35,200 will buy one lot. 34,200 we're going to sell 3 lots. 33,200 we are going to buy 2 lots, and 36,200 1 lot. 37,200 3 lot. 38,200 2 lots. Now this is a case actually where market was keep on going in one side. This is one kind of, see, next day only P has went to 92 rupees, which is from 32 to 92. This side now, if we definitely close the call leg, which should have eroded so much. So say we are closing at 6 rupees and we are buying somewhere around 16 rupees in call side. Now this call side you are going to be totally risk free, so you need not bother about that. But put side, even the next day again from 92 it has went to 140. So you are in a situation like only 34,000 market has already reached, and you will start encountering loss when it is moves more 200 points also, which is a very like kind of a likely happening scenario. When market has already moved 1,800 or 1,000 points from where you were, then it is better to exit the trade somewhere around 4,800 loss also. But actually in this case, what had happened is like very next day market has went up. So from 140 it has went to 43, then again I think it has went down, say again to 11 rupees, and finally this week again it was ended in profit, and I have given us profit of 4,000. But or else also you could have lost only 4,000 something, and you can end the trade. So you need not hold to the trade, because anyway you have very big range of 2,000. So you have this kind of buffer to make a risk on this kind of strategy, so that even if you're not going to lose much, you can just escape from the trade from losing very big amount, even if you're not making any profit. So these are the 4 scenarios that you might encounter when applying this strategy. So I have also given this summary, like out of the 16 weeks, 10 were profitable in this, you can see, and total profit we got was somewhere around 39,200, which turns out to be 2,500 around per week and 6.5% per month. And you can see like May and July were very good profitable months. June was okay. August, one more week was there. Like it is over, but in Opstra it has not yet come by the time I'm preparing this video. So that again should be considered. and this is overall you can see 26% ROA is like 6.5%, which is more than what 1 year FD returns is. So it's a very good ROA for the capital deployed. So, and as usual, like we close it in the morning for so that we can concentrate on expiry trade, or else you can just hold on to it and you can do till the end of the expiry. And you can personalize the strike, this 500, 1500, 2500 also you can change, and you can see as per your risk appetite, and you can do your own personalization and do these trades. So I hope this would have helped you in some way. Please do kind of subscribe to this channel and keep updating for any educational video or any strategies. Thank you. We will again meet in the next week.